Welcome to MacroHive Conversations with Bilal Hafiz. MacroHive helps educate investors and provide investment insights for all markets from crypto to equities to bonds. For our latest views, visit macrohive.com. So greetings and welcome, Cameron, to the podcast show. I'll be looking forward to our conversation.
Yeah, thanks for having me. It should be fun.
Great. Well, before we go into the meat of our conversation, I always do like to ask my guests their origin story. So why don't you tell us yours? Where did you study? What did you study? Was it inevitable you'd end up in finance? And how did you get to where you are today?
Yeah, I've kind of got maybe an unusual story insofar as my entry into financial markets. So I attended Duke University in the States, where I studied public policy and history. The history was just sort of a fun adjunct to the main degree. And as part of my public policy program, the first semester of my last year of university, I spent in Glasgow, the University of Glasgow, sort of the home of Adam Smith, to do a specialist program there. This was the autumn of 1992, which is when sterling was ignominiously ejected from Europe's exchange rate mechanism. And, George Soros broke the Bank of England, famously made $1 billion, et cetera, et cetera. And it's funny enough, it kind of happened as sort of the program was starting. And I remember being in the university bookstore, buying my pens and pencils and notebooks, and the radio talking about interest rates going up to 15%. No, isn't this horrible? And even I wired my beer money over. Cable was at 2. I think I got filled at 188, and it was 165 by the time I left. So that sort of stoked an interest in foreign exchange. And while I was on this program, I wrote my sort of thesis, as it were, about what the UK should do in the aftermath of its ejection from the exchange rate mechanism. And I'm pleased to say that I recommended that the Bank of England should be made independent 5 years before it was actually done so. So there's a little bit of perspicacity there. Anyhow, that sort of stoked my interest in FX, which was a topic I knew basically nothing about prior to going over to the UK. And so when it came time to look for a job, I ended up interviewing with Swiss Bank O'Connor, which was an option trading firm in Chicago. It was originally O'Connor, but it was in the process of merging with Swiss Bank. And I got hired in the foreign exchange group to learn how to trade foreign exchange options. And that was sort of my entree into...
So you were part of the O'Connor crowd then?
Yes. So at that point, the equity group was still legally O'Connor, but the currency group was legally Swiss Bank, because I guess there were various the regulatory hoops to jump through, depending on product, were slightly different. And the FX merger was consummated earlier. And obviously, for foreign exchange, it's better to have the wherewithal of a large Swiss bank behind you than it is just a boutique, private company in Chicago. Anyhow, so that was my entree into financial markets. I spoke a bit of French, so I'd only been in Chicago for 9 months, and the Matif, which was the futures exchange in Paris, was opening an exchange-traded currency contract. So I got kind of sent over to be a clerk stroke junior trader for that. It turned out that the thing didn't really take off. And more generally, it turned out that I didn't really have the temperament to be a market maker, which I think is required. To be a good market maker, you essentially have to have a kind of a poker player skill set, where you sort of assess not only kind of the fundamentals of your cards or your position, but you're playing against the other players. And you have to have an idea of what the other players want to do and what they're doing and reading them. And that wasn't really what I was temperamentally suited for. I much more enjoyed sort of kind of sitting back, stroking my chin, and analyzing about where things would be going, sort of moving forward based on sort of probabilities, which I guess you could call as more of a blackjack type framework of counting cards and playing the odds. So anyhow, that started kind of an odyssey still within Swiss Bank, where I lived in Paris and then Geneva and then Singapore, with Geneva and Singapore being more on the sort of the sell side, kind of derivatives, financial engineer type things. I had the derivatives fluency, the sales team didn't, and so I was basically trying to sell derivatives to clients. This was in the mid '90s, sort of. But I sort of knocked on the door of the guy who'd hired me, who at this point was in Singapore with me, and said, "Hey, I want to trade prop." And he said, "Well, no, but I'll tell you what, join the FX research group, bring that derivatives fluency to our FX research, and then we'll see what happens." So then I joined the FX strategy group at Swiss Bank. Like 6 months, I moved to London. Sort of 6 months later, we merged with UBS. So I was the sort of just a derivatives guy, but they sacked the Swiss Bank main strategist, and the UBS main strategist quit. So there was me, so the only man on the desk, as it were. And I didn't have this sort of formal macroeconomics background, but I was a pretty good writer because I'd enjoy writing when I was a kid. And so I blagged it for a couple of months, bought a bunch of textbooks about macroeconomics and principles of exchange rate determination. And sort of by the time they would have found me out, I actually kind of knew what I was talking about. So I ended up being the
That's the secret of many people's success in any industry.
Fake it till you make it, right? So I was an FX strategist at UBS by this point, as the merged group was called, for 3 years. But I still had this desire to sort of take risk. And so I eventually got headhunted to join a startup currency overlay manager in Dublin, which I went to. And ironically enough, my job there was kind of twofold. Yes, a little bit of portfolio management, but also economic forecasting. So having known nothing about sort of macroeconomics 3 years previously, I was now being paid to make forecasts, which I guess says something, right? So I was there for 3 years. It never really hit critical mass. So I eventually moved back to London, took jobs with sort of more traditional asset managers. One was kind of, didn't last very long for various reasons. But the other was Fortis Investments. So I ended up at Fortis running a pure currency alpha strategy within a global fixed income group. And this was in sort of the mid-noughties. Sort of 2000, I joined in 2004. But I knew that I kind of was interested in macro because I kind of got tired of having a view on, say, crude oil and having to take a position in NOK or Canada. It was sort of the C- articulation of a macro view. But there was this sort of chicken and the egg issue of how do you get a macro seat without a P&L? Well, you don't. But how do you get a P&L without a macro seat? Again, you don't. And what I found is that for the most part, hedge fund people weren't really interested in sort of a real money, currency only P&L. So my solution was I started this blog called Macro Man Blog, where I kind of wrote up my ideas and posted sort of a paper portfolio of macro trading ideas with sort of a calculated P&L. And a couple of years later, I ended up joining macro funds in London. And it was funny, when I went in for the interview, I had my macro man P&L in one hand and my real world P&L in the other hand. And the principal sort of looked at them both, took the real world P&L, sort of chucked it in the bin. And we just talked through the sort of the ideas that I'd had on the blog. So sort of my idea kind of paid off in terms of putting myself in the shop window there. So this was the beginning of 2008, which was obviously a pretty interesting time to to sort of join the hedge fund side and B, have the wherewithal to trade macro. And it ended up being pretty good. So both I and the fund did well in 2008. We did well in 2009. Everything looked great. I was very happy. Sort of went home sort of left work at the end of 2009, bought a new car for my wife. This is great. But the main investor of that fund was a large bank. And as you recall, in the aftermath of the GFC, large banks couldn't really take positions or hold positions in hedge funds. And so sort of come back in beginning of 2010, and sort of the principal said, well, they pulled the dough. So we're going to have to So
it wasn't because of performance or anything. It was just more to
No, absolutely not. Absolutely not.
So just performance was good. It was more just the investor pulled out because of the new regulation.
We were a moderate volatility fund, but I think we were up about 10% in 2008 and up 10% in 2009. So it was very, very, very steady. It was a group of like 5 maybe PMs, and we all worked really well together. So, it was one of those really unfortunate things. And I think it's a testament to the idea that a lot of the outcomes that we get in life generally and in finance particularly are down to luck rather than things in our control. Because as I said, their performance was excellent. And in a quote unquote just world, we would have batted on and continued, but because of the regulatory regime, that option wasn't available to us. So then I had to figure out what I was going to do. I had a pretty good P&L track record, two in a bit year or 2 years of a good track record. And I ended up deciding, well, I hadn't lived in the States in sort of 16 years. If I was ever going to move, that was sort of the time to do it. And so I moved to Connecticut, took a job with a big hedge fund here in Connecticut, and was there 4 years, started out really well, and then sort of suffered from the classic, what you might call the classic AUM shuffle. I did very, very well with a relatively moderate amount of capital under management, and then they jacked me up to a very large amount of capital under management. And my performance kind of suffered a bit. So I ended up in this position where I was up in percentage terms and down in dollar terms. In the hedge fund world, it's the dollar terms that matter, for better or for worse. And after 4 years, it was kind of like it wasn't really working out. So we parted ways. And that was this was in like 2014. It was kind of a really tough environment for macro generally because we were still in the midst of this financial repression. There wasn't much volatility. There wasn't really any policy vibrancy across a number of jurisdictions. It was just tough to get a seat. So I kind of just hung out for a couple of years. I still I couldn't write the blog when I was in the States for legal regulatory reasons. But once I left that fund, I started the blog up again. And eventually Bloomberg came knocking. And I was kind of facing a choice between, do I want to start one of these personal research boutiques, kind of along the lines of what you got, or do I want to work for the man? And I decided, hey, I'll give Bloomberg a try. Let's see how it goes. And and that's how I landed here, and it's been pretty fun.
That's great. That's a great story, and I do enjoy reading your columns. I mean, I have to say you're a very prolific writer. It's like you write almost every day or something.
Yeah, I've got a column that comes out every day. So in practice, what I do is I do a lot of the same analysis, looking around the world, looking at various assets that I did as a PM. Maybe 85% of the same work, but instead of identifying trades and implementing them and managing the risk, now I just write up the thought process that sort of led to that sort of final implementation phase as a PM. So I can't make forecasts, and I certainly can't recommend trades for regulatory reasons, but I can say, here's how I think the world is working and what that is going to mean for prices or for policy moving forwards. And it's like anything else, I suppose, whether it's like running. If you do it once a month or once a year, it's really, really tough to run 10K. But if you run 10K every day, well, running 12K the next day is kind of no big deal. If you get in shape to do it, and you become accustomed to it, it's the marginal effort isn't actually that high.
Yeah. And you traded risk in sort of different environments, different countries, different markets, and so on. I mean, what would you say, either in your own experience or the people you worked with, are the secrets of success for investors? I mean, is there something that you can distill, do you think? Or
well, the clearest one, I think, is know what your edge is. You have to know how you make money.
Yeah.
Showing up and say, well, if I like him today, I'm going to buy him. If I don't like him, I'm going to sell him. That's not really a sustainable edge. So you have to know what can you exploit in the market that you are better at than not necessarily everybody else, but most everybody else. Where's the gap? What's the gap that you're filling? That can be an analytical gap in terms of I can synthesize all these different assets with a specialist knowledge of economics and policy that maybe a former market maker doesn't appreciate. And I would say that was kind of my edge because I'd had this varied background. I'd done economic forecasting, I'd done strategy, I'd done option trading. I had this sort of broad background that I thought let me synthesize a lot of different aspects and sort of weave the tapestry or put the little pieces down to make the mosaic that I think most other people didn't have. Another edge would be, again, if you're a former market maker, you know the treasury market inside and out. I mean, maybe maybe you used to trade the 5-year note at Goldman. You know more about the 5-year note than anybody in the market. So when macro fund X or Y calls, this is the hammer for the 5-year note. That's you're not going to go there to trade Korean equities. You're going to go there to trade the 5-year note. On the equity side, obviously, it's easy. If you are an analyst or a PM who has a very specialist knowledge of a very specialist industry, or you've assembled a team of analysts, if you're a big brand name PM, you've assembled a team of analysts who can do that. That is an exploitable edge. Maybe your edge is you're very, very good. You're a very good poker player, essentially. And you can read the sort of ebbing and flowing of market sentiment on a short-term basis very, very well. That's an exploitable edge. And I think you could also argue that on an institutional basis, pension funds and the like have an edge in the sense that they're not constrained by sort of short-term mark-to-market considerations. So they can warehouse risk in a way that most other market participants can't. And that's an edge as well.
Yeah. And you obviously have this background, heritage in FX. I mean, do you think FX is a good asset class to trade in, or do you think it's not really a proper asset class?
I think it's a good asset class to come from.
Okay.
I'm not sure. It used to be a great asset class to trade. That has ebbed significantly in the post-GFC era. I think largely as a function of financial repression. And there was so little differentiation across policy settings, across geography, that it was kind of the good old-fashioned FX carry trade didn't really work. And volatility was very, very low. And so if there's no carry and there's no volatility, kind of by definition, there's no opportunity.
Yeah.
The last year or two has obviously made FX better because you have had policy differentiation across geographies. Carry has become more important in terms of driving returns. So it's certainly gotten better. What FX does have going for it, I think, and why so many successful macro investors have an FX background is, depending on your perspective, it's either the crossroads or the sewer of the global financial system. And sort of all cross-border transactions more or less eventually find themselves participating in the FX market, even if it's in only sort of a passive fashion. So to be good at forecasting FX on a sort of the intermediate to longer term basis, essentially you have to anticipate these capital flows primarily. You can, anticipating current account flows is also important. How important depends really on the jurisdiction, but anticipating capital account flows is certainly important. And to do that, obviously, it helps to have a view on the drivers of these capital account flows. So it naturally lends itself, I think, foreign exchange to an appreciation of other asset classes in a way that, say, being a fixed income person or being an equity person doesn't, right? If you're focused on Korean equities, for example, yeah, I guess the won is important, but does the South African bond market mean anything to you? Obviously not. Whereas if you're an EMFX trader, you kind of have to know about Korean equities and the South African bond market, if that makes sense.
Yeah, absolutely. And I have a FX background as well. And what I do find is it forces you to take, one is a global perspective. So you become, otherwise it's very easy to become very US centric with looking at everything. So, and allows you then to look at these shifts that occur when you have countries like China rising up. And as you said, it gives you this cross asset class, kind of cross market, perspective as well, because so many factors affect FX. Now, I did want to ask you about your current macro view. So do you have a take on where we are in the US cycle at the moment? Because there's lots of conflicting views out there. Some people are talking about recession. Some people are talking about, still inflation concerns. I mean, where are we in kind of the US cycle?
Well, I think it's relatively clear that we're fairly late cycle.
Yeah.
You've seen the classic deterioration in interest rate sensitive sectors of the economy, the housing market obviously being the most obvious, and that's a function of inflation and obviously the Fed's policy response. I don't think we're yet in recession because the labor market is still reasonably strong. Might not be quite as strong as some of the headline payroll numbers suggest, but the fact that you still have so many job openings, for example, even though the JOLTS number is lagged by a month, is certainly suggestive that the economy is still, broadly speaking, in an expansion phase, even if we have sort of downshifted. That having been said, it is facing the twin shocks of hits to real income. Household spending is 70% of the economy. So when 70% of the economy sustains a negative income shock, negative real income shock, which is what we've seen from inflation, that's obviously going to be deleterious to the prospects for the growth. And then obviously we've got the impact, the real-time impact and the future impact, lagged impact of Fed tightening. So I think that it's highly likely that we resolve in a recession probably next year. I'd say that view is admittedly not particularly controversial, but kind of when you run the numbers, I think that's kind of the obvious outcome. And the issue that's going to be really interesting to watch is how much tolerance will the Fed have for this if inflation remains relatively elevated. I mean, it's very easy to say when you think we're still in an expansion that, oh yeah, we're happy to tolerate below trend growth or maybe even a mild recession. We're happy to tolerate it if the unemployment rate goes up because we want to conquer inflation. It's kind of like saying, if the S&P goes down 50%, of course I'm good. I hope it does because I want to buy it down 50%. And what that really means is that, you want to have bought it 50% lower. But once you get that outcome in real time, your perceptions obviously could be a lot different than they are on an.
And so I guess that leads on to, I mean, what's your take on the inflation path then? Because it does look like we've got some early signs that inflation has peaked, and with certainly commodity prices, at least on year-on-year sort of changes have started to roll over. So we are seeing potentially this turn down in inflation. So, is this the phase now where inflation is no longer an issue and the Fed can just do a couple more hikes and stop or cut?
I think we have to acknowledge that there is a yawning gap between inflation has peaked and inflation is where it needs to be.
Yeah.
Right. And we are moving ever so slightly, gingerly into that phase. Clearly, base effects, what have you, on a year-on-year basis, inflation is almost certainly peaked. I think on a run rate sequential basis, it's also likely peaked. You've seen the used car stuff start to roll over. Some of these idiosyncratic factors that drove inflation higher are not going to contribute in the way that they have. That being said, in terms of reported inflation, we know that the housing numbers, the shelter numbers, tend to lag activity in real-time activity in the housing market. So I would expect an ongoing, significantly positive contribution from housing for the next 6 to 12 months on the one hand. And I also think there's this element of hysteresis in the sense that uh, we're likely to see whatever the Michigan numbers, the New York Fed numbers say. There is in the real world this embedded expectation of inflation, and we're likely to see prices continue to rise after the proximate drivers of inflation, that being the imbalance of supply and demand, aren't necessarily as significant as they have been in the past. So my core expectation is that we sort of downshift from the run rate of sort of 8-9% that we've been running at to maybe a run rate of 4 to 5%. And that raises the interesting question: is that it's obviously lower than we are now, but it's higher than the Fed wants it to be. So what do? And my expectation is that they essentially continue tightening until something more obviously breaks.
And so the market is currently pricing a peak for the Fed of around, say, 3.5% or so, depending on ballpark, plus or minus. I mean, do you think that's just too low? I mean, they have to at least go to, say, 4.5 or 5, or do you think it's still an open question? They could just do 3.5 and avert a recession and just say we're fine with, they won't say it's fine, the higher inflation, but just accept higher inflation.
I tend to think that they will go a little higher than 3.5. And I also tend to think that we won't get up to 4.5 or 5. I mean, I think the economy will be more obviously slipping into recession somewhere between, say, 3.5 and 4.5. I mean, relative to the level of inflation, 3.5 is obviously farcically low if you look at a Taylor rule type prescription. But I think we know that the Fed is not looking at a Taylor rule type prescription. The interesting question, and then unfortunately we don't know the answer except on an ex post basis, is what's the short-term neutral rate? Yeah. They've got this idea that the long-term neutral nominal rate is around 2.5. Maybe that's right. Maybe it isn't. Who knows? But on a short-run basis, we've got no clue. What we can say, though, is that it seems very, very likely that we're going to end up with a significant rise in the real Fed funds rate over the next 6 to 12 months. We've already started to see it move up. But the issue, I think, is we're moving from ludicrously negative levels to less ludicrously negative levels, and eventually perhaps even positive. And I don't think you can get that sort of abrupt adjustment in the real policy rate without, more significant disturbances in financial markets and likely the economy.
And so some of the consequences of that, one on the rate side, do you think that means that we'll have, can, say, 10-year yields go up much further or not? Or will we just have this big kind of flattening that will keep the long end fairly well anchored? So the rates market, we won't necessarily get this big yield shock like we got earlier this year. So maybe how do you see kind of the yield shock at the long end side, unfolding?
Yeah, I certainly think that the 10-year yield can move higher, and indeed it should move higher. I mean, I've got a little model that I use to try to explain the 10-year in the context of where the Fed fund rate is, where inflation is, where employment is, and where expectations for Fed policy are. And plugging all those numbers in, my model suggests 10-year should be, I think, 3.30 or so. Okay. So yield is already lower than where it quote unquote should be. Now, obviously, a model is a representation of reality rather than reality itself, and the market yield is what the market yield is. But I would say that the rally that we've seen since the June Fed meeting was probably a bit overcooked. And that has been a function of a reduction in the estimate of the peak funds rate, which has, to a large extent, but not complete extent, unwound, and the expectation that the peak will be followed swiftly thereafter by significant rate cuts, which if the raison d'etre for the end of the tightening cycle is a more obvious swing into recession, then yes, that's justified. If the Fed thinks that they've managed to pull off a soft landing, then the duration of resting at the terminal policy rate could be somewhat longer than the consensus expectation is, or at least what's priced into the strip. And the Fed alluded to that. Sorry, the Fed alluded to that very fact in the minutes of the July meeting, where a number of the members said that the expectation would be that rates would be held at the peak level or the terminal level for some time.
Yeah, and at the same time as the policy rate increases, we also have quantitative tightening as well. Do you think? Well, one is, how's that progressing? Are we seeing the Fed selling, winding down their portfolio or not? And then secondly, what impact do you think that will have on markets?
Okay, the QT issue is a really, really fascinating one, I think. In QE, quantitative easing, the focus is all on the asset side of the balance sheet, right? How much stuff is the Fed buying? And that's all you really care about. In QT, I think the focus needs to be more on the liability side of the Fed's balance sheet, i.e., the money that's being drained out of the system. Where is it coming from? Is it coming from bank reserves? Is it coming from this reverse repo facility that essentially money market funds have all this cash? They don't have enough treasury bills to buy, so they just plunk it at the Fed. Or is it coming from the treasury zone account at the Fed? Now, there's two issues that I think are worth noting thus far, sort of 10 weeks into QT. One is that the private sector hasn't been impacted by QT at all, in the sense that reverse repo balances are up by, I think, something like $210 billion since the end of May, or since the start of June. Bank reserves are basically unchanged since the start of June. It's the Treasury general account that's fallen by essentially an equivalent amount to the rise in the reverse repo facility. And then other deposits at the Fed have fallen by about $30 billion. And that is deposits from like multinational organizations or other official type organizations. So sort of public sector, NGO type organizations, I think. So if you haven't seen bank reserves drop and money market balances at the Fed have actually risen, effectively, has there really been QT? I think you could probably say not really. Now, QT bit or had a more meaningful impact in the market last time when bank reserves dropped to a level that caused ructions in funding markets and liquidity. And that came when bank reserves as a percentage of overall bank liabilities fell below 11% or so. Now, an equivalent threshold this time around would be roughly $2.1 trillion of bank reserves. We're currently at $3.35 trillion. So we've got
quite a big cushion.
We've got some ways to go. So all of that, in sum, looking at the liability side of the Fed's balance sheet, there hasn't been QT at all because the private sector hasn't been impacted. On the asset side, there's also an issue, which is, and we're recording this on the 18th of August. QT ostensibly started beginning of June, right? Now, they've been doing a run rate of $47.5 billion per month, presumably, since the start of QT, in which case, a month and a half or 2.5 months in, you would expect the Fed's balance sheet to have shrunk by essentially $119 billion, which is 47.5 times 2.5. In fact, it's only shrunk by $36 billion. So they've been running QT at a much slower rate than implied by these roll-off caps.
Okay.
And that's
so they announced these roll-off caps in June, say this is how much they expect to see.
Yeah, well, they announced them in May.
In May, to be in effect in June, and it's way below what they said.
It hasn't done what it said on the 10th.
Yeah.
Right. And there's two reasons to that. One is that the Treasury roll-offs haven't been as big, obviously, as you would have thought. I think they've rolled off $50 some odd billion. since the beginning of June. We've got data from the Fed's balance sheet on the 1st of June. So that's what I'm using as my reference point. The roll-off has been like I think like $55 billion. I have the number somewhere, but my screen's minimized at the moment. But the really interesting aspect is that MBS, which is supposed to be rolling off at $17.5 billion per month, hasn't rolled off at all. In fact, MBS holdings have actually risen slightly since the start of June. And this is one of the really interesting issues about the Fed's QT, is that we know that treasuries have fixed maturities, right?
Yeah. So we know when they're going to roll off.
Yeah,
so
a bond that matures on September 15th. Yeah. You know, the Fed knows it's going to get the dough on September 15th plus whatever the settlement lag is. MBS, you're kind of hostage to mortgage holders. You don't get the money until someone prepays. Yeah. And right now, with mortgage rates where they are, no one's prepaying. Because if you look at the composite, and I wrote about this, incidentally, a little plug, in my column this very day. If you look at the composition of the Fed's MBS holdings, most of the coupons are like 2.5%, 2%. No one's refinancing a 2.5% mortgage when 30-year mortgage rates are 5.25%, which is where we are now. So essentially, the Fed's prosecution of QT via MBS is totally out of their hands, and it's totally unreasonable. Excuse me. It's totally unreasonable to expect these mortgage bonds to roll off in line with the caps announced by the Fed because no one's prepaying. And so the natural conclusion is that to get the balance sheet to shrink in line with these announced amounts, they're eventually going to have to start hitting bids.
So they're going to actively have to sell their mortgage holdings to reduce their assets rather than waiting for them to
exactly. The only way to get these assets to roll off organically is to slash interest rates and get mortgage rates
which is not what
low enough that prepayments become attractive. But of course, that's counterproductive given inflation where it is. So I think at some point in the next few months, people need to prepare themselves for a headline that says essentially Fed is going to start hitting bids in mortgage-backed securities, because it's really the only way I think that they can get QT to on the mortgage-backed side to evolve along the lines that they've.
And then presumably the consequence of that would be that mortgage rates would shoot up by more than would otherwise be the case.
On the margin, I'd say. I mean, mortgage spreads are already pretty wide.
Yeah.
So and maybe that's an anticipation of the Fed starting to whack some of these bonds. I think this is an issue that's not terribly well appreciated by sort of tourists or non-fixed income people, but people who trade mortgages are acutely aware, I think, of what's going on with the Fed balance sheet and what the likely ultimate outcome is going to be here.
Yeah. Now we talked about recessions, but in terms of market risk, like a systemic event or some kind of larger volatility event, I mean, what do you think the chances are of that? You mentioned earlier that we're going from an environment of very low real Fed fund rates to, something higher. It may still be low, but it's something different to before. So surely something's going to crack, in markets.
Yeah. I mean, the interesting aspect of what's going on these days is that trading liquidity is pretty bad.
Yeah.
In equity markets, for example, I've got this measure that it attempts to tease out what trading liquidity is. I compare the trading range of the S&P with the amount that's actually traded and sort of index that. And when I looked at this a couple of days ago, we were at like 38% of the long-term average average liquidity. And the only times we'd been lower than this were the height of the GFC and the nadir of COVID. So trading liquidity, even during this rally, has been terrible. And I would argue that the magnitude of the bounce that we've seen since June is in fact a function of this terrible liquidity. Because unlike normal circumstances over the last 3 decades, I mean, it's kind of an underappreciated fact that essentially the entirety of the S&P's rallies over the last 30 years has come from overnight gaps. The S&P basically has done nothing from the time the opening bell rings to the time the closing bell rings, cumulatively over 30 years.
Yeah.
Since since June 16th or whatever the nadir of the S&P was, essentially all of the gains have come during the day rather than these overnight gaps. So we've completely turned the historical pattern on its head.
And what's the reason for the earlier 30-year phase?
Well, I think the argument, I mean, there's various arguments, some very, very technical. I think the common sense argument is that, a lot of news comes out after the close. Like a lot of earnings news, for example, comes out either after the close on T0 or before the open on T+1. And that becomes prices adjust on the open accordingly. That makes sense. There's been, the New York, or I can't remember if it's the New York Fed or some Fed researcher has got this alternative explanation of sort of book matching from banks and dealers or whatever. But, I think it's a more satisfying answer that, when Microsoft reports good earnings at 4:30 on a Tuesday, it gaps higher at 9:30 on a Wednesday. That's kind of.
And so, what would explain then the reversal of that since June? You said so. Now,
my hypothesis is that trading liquidity has been so bad that even marginal flows are pushing prices much more than they normally would. And if your starting point is a market that's fully hedged and or underweight with very high cash holdings, which I think is probably an apt characterization of where we were in mid-June, as those hedges get unwound or as some of that cash gets deployed, there's a disproportionate move in the cash market relative to history because liquidity is so poor and there's really no one to take the other side at this particular point in time.
No, that's a great observation.
And so it naturally raises the question of what happens if and when the tide turns and the flow becomes more balanced or more negative. Well, in the absence of an improvement in liquidity conditions, and I think it's a Herculean ask for liquidity conditions to improve if the market's going down, then you'd have to say that the risk is that you get another uptick in volatility, and we're sort of right back where we were a couple of months ago. It's easy to forget that as we trod the path from the ding-dong highs in March of 2000 to the ultimate low in October of 2002. And indeed, I think from March 2000 to sort of the end of 2001, there were 7 different 20% rallies in the S&P. And each one was eventually followed by a lower low. Right now, we've had sort of one. And I think there's a lot of speculation that, hey, the worst is over. It's all happy days. But I think that is very, very optimistic. And it's conflating a low liquidity short covering rally with a significant improvement in the fundamental backdrop, which I don't see.
And, one of the features of the .com crash was that in the end, it had a fairly small impact on the broader economy, in the sense you had this crash, there was a mild recession, it was nothing like the GFC. Do you think that that's the nature of the type of crisis we'll get? It will be kind of like an equity type event rather than a fixed income credit balance sheet event, which could be much more deleterious.
I think that is a pretty good base case scenario. I don't get the sense that there's the degree of institutional leverage that we had in the run-up to the GFC, and there's certainly not the household leverage that we had in the run-up to the GFC. And it's always difficult to look at top-down aggregates and know how they're spread across the entire population, but cash as a percentage of GDP, cash on household balance sheets as a percentage of GDP is far, far, far higher than it's ever been before. It's like 75% of GDP is held by households in cash. Now, obviously, not everyone has the same amount, but that still suggests that there's a pretty good cushion there to guard against the implication of financial distress. Are individual people exposed? Obviously.
Yeah.
Crypto is an example, I think, where there is probably quite a bit of exposure, and crypto is where there is a lot of institutional leverage in terms of cross holdings and general recreating the sins of traditional finance. 100 years of sins of traditional finance compressed into a decade of crypto.
Yeah.
And so
and what do you think about private markets, private equity, VC, things like that?
I think based on the investment into the WeWork guy, $350 million to reinvent the apartment REIT, except you don't get a tax benefit. I think there's probably still too much money chasing too little opportunity. And, it's not really our job to say, I would like this to happen. It's our job to say, this is what I think will happen.
Yeah.
But, if you'll allow me a brief digression,
sure.
I think it would probably be good for just about everyone if private capital took a hit and they weren't quite so free with throwing money at obviously money-losing propositions. Right?
Yeah.
I mean,
Fair point. Yeah.
I mean, have you seen the story about DoorDash? There's this guy owns a pizza parlor, and he sells his pizza for $24. And he found out that DoorDash was selling them for $16. So he ordered his own pizzas from DoorDash. He would sell them to DoorDash for $14 and then buy them back from DoorDash for $16. Okay. 2024. So he'd sell them to DoorDash for $24, buy them back for $16. So he'd make $8 a pizza and have a pizza.
Wow.
It's great
to see a pizza guy doing an arbitrage.
DoorDash, if you don't know, is kind of like Deliveroo. It's one of these food delivery. And it's a VC darling, and it loses money hand over fist. And it's one of these things that I guess every funding round, it seems to be worth more. And the more it's worth, the more money it loses.
Yeah.
I mean, I'm not sure how that's sustainable in the long run or even beneficial to society. But
well, there's
a brief digression there into the norm rather than the actual.
Yeah. And outside of the US, I mean, do you have any thoughts on China? Because obviously China, has gone through its own challenges over the past year or two, whether it's property, woes, clamp down on the private sector, zero COVID strategy, and so on.
Yeah, I mean, China, from afar, it looks like they've scored a spectacular series of own goals, doesn't it?
Yeah.
With the zero COVID policy, with mismanagement of the property sector. I'm not sure how they get out of the property issue without doing the usual massive bailout, throw money at it. It's tough because there's clearly a sort of an ongoing reorientation of policy in China, where kind of the Communist Party has decided to become communist again. It kind of feels like, for sort of the, whatever it was, the 20 years since Deng Xiaoping, they kind of evolved into quasi, capitalist or, capitalism with Chinese characteristics or whatever you want to call it. But they seem to be moving more overtly towards a statist, communist orientation with the shared prosperity and program and what have you. So I think it makes China very difficult as an investment proposition at the moment. And it probably means that we shouldn't expect the sort of ride to the rescue stimulus that sort of radiated across the world that we had after the GFC. Whereas you may remember, I think it was 2009, they did this massive stimulus and they were just ended up buying every commodity under the sun. I don't, that's kind of, we've moved, those days are gone now. So it's a lot more problematic. As far as
and how do things look from where you are on Europe?
I mean, they're stuffed. I mean, I don't know how else to say it. it's one of those. There is no sort of Nash equilibrium, or I mean, there's no sort of optimal policy choice. I mean, I think that's the message on Europe. It's just an array of bad choice. I mean, I could make a joke about UK politics, but I'll refrain. It's just an array of bad choices. In the sense of you've got this obvious terms of trade shock from the energy sector, and it's not clear that that's going to be resolved adequately. I mean, you look at some of these winter gas prices, and it is quite literally properly scary what gas prices are doing. It's not clear that Europe as a whole can afford that hit. There's issues of energy policy. I mean, from my perspective, Germany. I mean, it's not, unfortunately, a nuclear power plant isn't like a car. You can't just take the keys out of the drawer and go and turn it on and sort of get going. But at the very least, Germany, needs to maintain its current nuclear capacity and think about adding to it rather than mothballing it, because it's an obvious way of sort of circumventing the dependence on Russian fossil fuels. For better or for worse, that's a question or an issue that isn't necessarily resolved on the basis of pure economics. And it's a political question rather than an economic question in many cases. Although I think if the economics become pressing enough, then suddenly we'll find it's an economic question.
Yeah.
But for the ECB, what do? I mean, inflation is clearly too high. You don't want inflation expectations to become unanchored. But obviously, the rise in energy prices has got nothing to do with the price of money. I mean, you could argue there's a tangential impact in the sense of the euro price of dollar-denominated energy is exacerbated by the weakness of the currency. So a policy response that helps boost the currency offers some sort of protection. But, that's kind of like wrapping yourself in tinfoil and as insulation for a snowstorm in the Arctic. It's just not enough. I mean, when you've got energy prices trading on a 50 or 100 vol, and you've got an 8 or a 10 vol currency, getting the 10 vol currency to bounce is nice, but it's not going to really do much to impact the trade shock from the 100 vol move in energy prices. So what do? I mean, I think not taxing the banking system is a good start. I mean, it's been idiotic, this sort of negative interest rate policy they've run for 8 years now, or that they had been running for 8 years, which was essentially a tax in the banking system. I mean, is it any wonder that the flow of credit wasn't totally unleashed when banks have to write a check to the ECB for their deposit holdings? I mean, that was obviously silly from the get-go, but my opinion doesn't matter.
And so we've covered lots of ground here. I mean, is there anything else that you're looking at that we haven't discussed?
I'm sure there is. I mean, I would say that going back to equities, and that's not just U.S., but generally. I mean, I think we have seen most of the adjustment in earnings multiples as a result of the interest rate adjustment. Obviously, we've unwound some of that recently, so I guess there is a little bit of possibility for movement there. But it strikes me that the real shoe to drop that we haven't seen yet will be on the earnings side.
Yeah,
right. Yeah. Because earnings are still at peak, so that's what I would be watching out for.
And have you been surprised how positive the most recent earnings season has been?
Yeah, I would concur. I mean, the magnitude of the surprise wasn't that big. It's one of the lowest that we've seen since COVID, at least in the U.S. But I mean, I guess it has something to do with the structure of the equity market, where under promise and over deliver.
Yeah. I mean, what I find interesting was the guidance was fairly positive. I mean, they when you listen to the conference calls, they were fairly upbeat about their revenue numbers for the following 6 to 12 months. They weren't pitching themselves as much.
Yes, although I mean, I guess you could argue that if inflation remains elevated, then the real growth in revenue,
okay, yeah, that's fair.
Adjusted,
That's fair. Yeah, of course.
Isn't quite as good. And I look at someone like Walmart, where they guided lower a few weeks ago. Yeah. And then they announced earnings like, oh, we actually did better than we thought we would. And this picture isn't so bad. I mean, okay, classic under promise and over deliver. Yeah. Right? So there's a sort of this institutional bias that you kind of have to look through there.
Yeah, that's fair. Now, I did want to ask you some personal questions as well. So the first one was, what's the best investment advice you've ever received from anyone else?
Don't be afraid to admit when you're wrong.
Right? Okay, yeah, that's a good one.
Another way to phrase it is by a question. Do you want to be right or do you want to make money?
Yeah.
Because I think a lot of people want to be proven right and will engage in sort of confirmation bias and sort of cherry pick reasons why their investment proposition is right. Whereas your ultimate goal as a trader and an investor is to make money. And and this is why I like to think in terms of a blackjack. I don't really play cards, but I find the strategy is fascinating. Why I like to think of a blackjack approach, a card counting approach, where the consequence of any single bet is kind of irrelevant to the ultimate success of the strategy. If you follow the process of managing your risk and allocating risk according to the opportunity set, and then you have a robust edge, then eventually you will succeed. But becoming fixated on winning a given hand or being right on a given trade, I think is counterproductive to longer term success. And it's a temptation because intellectually we always want to be right. And it somehow seems a weakness to admit that you're wrong, whether you're a trader who doesn't want to stop out or a talking head who feels like you're not credible if you're not right all the time. Well, in fact, you're not credible if you are right all the time because nobody is right all the time. And so if you don't sort of own up to your mistakes or own up to getting it wrong, then you're obviously not representing yourself correctly. So not being afraid to admit that you're wrong is
that's a great piece of advice. And another thing I wanted to ask you was, we have a segment of our audience who are students, and many of them are leaving university now, they're entering the job market. Obviously, it was a while ago where you were in that position, but what advice would you give new entrants to the job market about what they should think about career-wise and how to sort of manage that transition from university to work?
Yeah, I mean, that's a tough one these days. I think, the obvious one is learn to code, right? Which is sort of the cliche. Like, I think these days it's as much about managing the whole culture in the sense that since COVID, we've now got this sort of bifurcation or bifurcated word between remote work and in office work. Now, I think if you're 22 years old or 23 years old and you're living in New York City and you've got an office in Manhattan, you're naturally more predisposed to be in the office than you are in your little box in whatever, the Upper West Side or whatever. And if you don't have that many friends because you've just moved to the city from North Carolina or Arkansas or whatever, obviously you want to go out, you meet people in the office and what have you. So that's natural, but it's important, I think, to be there early doors because that's how you learn. If you're in a position where you're in your career where your learning curve is highest or steepest, you want to be physically in the position where you're going to move most quickly up that curve. At the same time, I think there's the obvious that you want to demonstrate you're a hard worker. You want to demonstrate that you're smart. You want to demonstrate that if possible that you're a good person. Right. That's most easily done by working hard and being there and doing what you need to do without complaining. The further out your career you go, and the more that your journey of discovery or your learning process, your learning curve naturally flattens out. Hopefully it never becomes totally flat because then you're just stagnating. But once it starts to flatten out, then a lot of your learning becomes more self-directed. And you can do that. That's more of a thing you can do in a kind of irrespective of physical location.
Yeah.
I don't want to be one of these Malcolm Gladwell people that says, "Oh, everyone needs to go back to the office except me." Right? I don't know if you saw that.
No, I didn't see that.
No, he made some big song and dance about how everyone needs to work in the office, but he himself obviously does not work in a corporate office. I don't want to go down that. I don't want to go down that path. But I think at least being sensitive to these issues of how you learn most efficiently and how you progress your career most efficiently in your first couple of years is important, and managing that in a context where not everyone else who's senior to you is going to be in the office is a challenge. I don't know exactly what the right answer is, but I think the general principles of showing up early, working hard, and not being a jerk probably help.
Yeah. And another question, I'm quite into, understanding like productivity hacks and such. And, I know you're very, you sort of deal with lots of diverse information sources, you're on top of lots of different markets and so on. So do you have a system to stay on top of things or some way or hacks or something to make sure that you're able to do your job well?
I guess yes, in the sense that I've had the same Bloomberg screen set up for about 20 years. So, obviously I've added and subtracted things as the case may be, but I know exactly where things are, what I want to look for, et cetera. And part of it is kind of knowing your process inside and out, and knowing what things matter to you and what things don't. I mean, I would say my biggest productivity hack, which it might be a little surprising to you, is I more or less ignore all the news. I don't have any sort of news scroll headline on my desk, because I think it's 99.9% noise.
Yeah.
And only a very vanishingly small percent signal. So I'm not interested in noise. I'm interested in signal. And so I tend to fixate on signal. So I spend much more time in spreadsheets playing with data than I do looking at, obviously, the latest news headlines or very, very short-term market moves. Now, if you are a market maker or a short-term trader or a news reporter or something that has to have an explanation for or a reaction to every single ebb and flow of the market, well, then your situation is different. But if you're not in that position where you need to react to every single little ebb and flow, why expose yourself to noise that just pollutes your process? To me, that doesn't make any sense.
Yeah, no, I'm sympathetic to that as well. And now, the other question I want to ask you was on books. Are there any books that really influence you over your career?
Yeah. This is a fun question, because this is where the intersection of my interest in sort of finance and history and what have you becomes evident. I mean, I suppose like everybody else that's on this podcast, I suppose I have to say Memoirs of a Stock Operator, because it's fun to read, and it does offer insight into psychology.
Yeah.
And I would say, kind of as I've alluded to, the psychology aspect is one of the weaker parts of my analytical framework or my investment process back when I was a PM. So I do like to go back to it every so often, just to kind of get a refresher. So that's point one. I would say the Market Wizards books from the 80s are also great. They might seem super dated now because the finance has moved on and there are some latter day equivalents. But back when I was managing money, I used to reread those every few years. Now, I will say that you have to be careful when you read them, because what you don't want to do is to try to co-opt somebody else's investment process to your own. You can only manage money or trade in a way that you are intellectually and temperamentally suited to. And it might be really interesting to read that Paul Jones does this, but he's Paul Jones, not Bilal or Cameron or Joe or Jenny or whomever. And something that Paul Jones might find very easy to do intellectually or temperamentally might not be something that you or I can do very easily. And if we try to change ourselves to become someone we're not, that can lead to danger or to sort of substandard results, shall we say. So the books are interesting to read, and you do try to glean a few little nuggets here and there, but it's also important not to engage in style drift just because someone more famous than you or who was famous enough to be in a book 30 years ago or 40 years ago did it. So that's that. I think Kindleberger's Manias, Panics, and Crashes, which is sort of more of an academic study of financial excess over the years. I think it was published in 1978. So obviously it's quite dated at this point, but still has some good insights into history. And an equivalent book that's more narrative was written, I think, in 2000, or published in 2000. It's called Devil Take the Hindmost by Edward Chancellor. I think he's still at GMO. But that's more of a narrative history of sort of financial excess. And it's quite entertaining, and it's remarkable how often you spot the same sort of patterns of behavior across time, across geography, across markets. So, kind of squaring the circle to the crypto illusion earlier. I mean, people think that they've reinvented the wheel, but as the saying goes, there's nothing new under the sun, and a lot of the same mistakes get made by people who think that this time actually is different when it's not.
Yeah, no, it's a great selection of books actually, and they're all time tested as well. I mean, they've all stood the test of time.
Yeah.
Now, finally, if people wanted to follow you, what's the best way for them to do that?
Okay. Well, my work is pretty much confined to the Bloomberg terminal.
Okay.
For better or for worse. So if you are a Bloomberg terminal subscriber, you can find my daily column at NI Macroman, which is one word.
Okay. Yep.
I also write for the Markets Live blog, which is MLIV.
Oh, yeah. Yeah.
I am on Twitter, which is at Fifth Rule. But
Fifth Rule. Okay.
Yeah. I almost never tweet. Because,
okay. But just out of interest, Fifth Rule, what's the story behind that?
It's a cycling analogy or a cycling illusion, bicycling. I'm not going to say what it is.
Okay.
If you Google, if you Google rule number 5, you'll
okay. I'm intrigued.
You will probably find out what it means.
Yeah. Okay.
Anyhow, I don't tweet very often at all because I think 99% of the people tweet 100% too much. So I try to only tweet when I have something to say.
Okay, no, that's great. Okay, so I'll include some links to the Bloomberg side, perhaps, and your Twitter. Well, with that, I just wanted to say a big thank you. It's been a great conversation with you, and I'm a regular reader of all your content, and so I'm sure those who read or haven't read your stuff would enjoy it if they're able to as well.
Well, thank you very much. It's been thank you for having me. It's been a pleasure to catch up.
Thanks for listening to the episode. Please subscribe to the podcast show on Apple, Spotify, or wherever you listen to podcasts. Leave a 5-star rating, a nice comment, and let other people know about the show. We'd be super grateful. Finally, sign up for our free newsletter at macrohive.com/free. That's macrohive.com/free. We'll be back soon, so tune in then.